the psychology of money, why we made bad decisions, understand the behavioral biases that lead to poor financial choices. Money is not just about numbers, budgets, or investments. Every financial decision we make is influenced by emotions, habits, beliefs, past experiences, and the environment around us. Two people earning the same income can end up with completely different financial outcomes, not because they know different math, but because they think differently about money. The field of behavioral finance has shown that humans rarely make perfectly logical financial decisions. Instead, our brain rely on shortcuts called cognitive biases. These shortcuts help us make good decisions, but they often lead to costly financial mistakes. From overspending during sales to panic selling investments during market crashes, our emotions frequently overpower logic. In this video, we will explore the psychology behind money and uncover 10 powerful behavioral biases that silently influences our financial decisions. By understanding these mental traps, you will be able to make smarter choices, build lasting wealth, and improve your financial future. Point number one: money decisions are emotional, not logic. Most people believe they make rational financial decisions. In reality, emotions like fear, excitement, guilt, stress, pride, and hope influence nearly every purchase and investment. When we feel happy, we often spend more. When we are anxious, we may avoid investing. During uncertain times, fear causes people to sell investments at the worst possible moment. Businesses understand this psychology and use emotional marketing to influence buying decisions. Luxury brands sell status, not products. Advertisements create urgency and scarcity because emotional decisions happen faster than logical ones. Even experienced investors struggle to separate feelings from facts. Understanding that emotions drive money decisions is the first step toward building financial discipline. Instead of asking, "How do I feel?" successful will ask, "What does the evidence say?" Emotional awareness does not eliminate feelings, but it prevents emotions from controlling financial behavior. Wealth is often created not by making brilliant decisions, but by avoiding emotional mistakes consistently over time. Let's say example. During a stock market decline, Rahul panicked and sold all his investments. His friend Priya stayed invested despite temporary losses. 1 year later, the market recovered and Priya earned significant returns while Rahul had to buy back at much higher prices. Next, point number two: loss aversion. Why losing hurts more than winning feels good. One of the strongest psychological biases is loss aversion. Research shows that losing $100 feels about twice as painful as gaining $100 feels rewarding. Because of this, people avoid risk even when the potential rewards are much greater. Investors often hold losing stocks for years because selling forces them to accept a loss. Others refuse profitable investments simply because they fear short term declines. This bias also affects everyday spending. People hesitate to cancel expensive subscriptions because they focus on wasting previous payments instead of future savings. Businesses use free trials knowing people dislike giving something up after experiencing it. Understanding loss aversion helps us make decisions based on further value rather than past emotions. Every financial choice should focus on expected outcomes, not emotional attachment to previous losses. Example: Sarah bought shares at $100. The price dropped to $70. But instead of selling after realizing the company had weak fundamentals, she held them for years because she could not emotionally accept the loss. The shares eventually fell to $30. Next, point number three: herd mentality. Following the crowd can be expensive. Humans naturally seek safety in groups. This instinct helped our ancestors survive, but in finance, it often leads to costly mistakes. When everyone is buying houses, cryptocurrency, or popular stocks, many people assume it must be a good investment. Likewise, during market crashes, people panic because everyone else is selling. Herd mentality creates bubbles and crashes throughout history. Social media has made this bias even stronger. Viral investment trends spread up within hours, encouraging millions to invest without proper research. Successful investors don't ignore public opinion completely, but they verify facts before following trends. Independent thinking is often uncomfortable, yet it's one of the greatest financial advantage anyone can develop. Real wealth usually comes from patience rather than popularity. Example for this point: during a cryptocurrency boom, many people invested simply because Friends were making money. Some entered at record prices and suffered heavy losses when the market corrected. Next point number 4, instant gratification. Why today always feels more important than tomorrow. Our brains are wired to value immediate rewards more than future benefits. Psychologists call this present bias. Buying something today feels exciting, while saving for retirement decades away feels boring. This explains why many people struggle to build emergency funds despite knowing their importance. Credit cards make instant gratification even easier by separating purchases from immediate payment. Companies design products and advertisements to exploit this bias, offering buy now, pay later options and limited time discounts. Financial success often depends on delaying gratification rather than increasing income. Small sacrifices today can create enormous opportunities in the future through saving, investing, and compound growth. Example: Alex spends $8 every day on unnecessary online purchases. Jamie invests the same amount daily. After many years, Jamie builds substantial wealth while Alex only has memories of the short lived purchases. Next, point number 5, overconfidence bias. Believing we know more than we actually do. Confidence is valuable, but overconfidence can become dangerous in finance. Many people believe they can consistently predict stock prices, property markets, or economic events. After experiencing a few successful investments, confidence grows rapidly while risk awareness declines. Overconfident investors trade frequently, underestimate uncertainty, and ignore expert advice. Research consistently shows that excessive trading often reduces long term returns because of poor timing and a higher transaction cost. The most successful investors remain humble. They acknowledge uncertainty, diversify investments, and continuously learn instead of assuming they already know everything. Example: After making profits in three technology stocks, David believed he had mastered investing. He invested nearly all his savings into one company without research. The business failed, causing significant financial losses. Next, point number 6, confirmation bias. Seeing only what we want to believe. Confirmation bias causes people to search for information that supports their existing beliefs while ignoring evidence that contradicts them. Once we believe an investment is excellent, we naturally follow positive news and dismiss negative reports. Social media algorithms strengthen this problem by showing similar opinions repeatedly. Investors trapped in confirmation bias become emotionally attached to ideas instead of objectively evaluating facts. Good financial decisions require actively searching for opposing viewpoints. Challenging our own assumptions improves decisions quality and reduces unnecessary risk. Great investors often ask, what evidence would prove I am wrong? Let's say example, Emily believed a company would become the next global success. She only watched optimistic videos and ignored declining revenue reports. Eventually, the company stock lost most of its value. Next, point number 7, lifestyle inflation. Why higher income does not always create wealth. Many people assume earning more automatically leads to financial freedom. However, as income increases, spending often rises at the same pace. This behavior is called lifestyle inflation. Bigger salaries lead to bigger homes, luxury cars, expensive vacations, premium gadgets, and higher monthly expenses. Instead of increasing investments, people increase lifestyles. Financial independence comes from widening the gap between income and spending, not simply earning more. Wealth grows quietly through consistent saving, while lifestyle expansion often happens slowly through visible purchases. Example: Two friends receive identical promotions. One upgrades every aspect of life immediately, the other increases investments while keeping expenses stable. 10 years later, their financial positions are dramatically different. Point number 8, anchoring bias, letting the first number control our decisions. Anchoring occurs when the first number we see influences all future judgments. Retail stores display high or original prices before discounts to make offers appear attractive. Investors anchor to the price they originally paid for an asset, believing it should return there even when circumstances have changed. Salary negotiations, real estate pricing, and investment decisions are all influenced by anchors. Smart financial decisions require evaluating present value instead of comparing everything with historical numbers. Example: A laptop originally priced at $2,000 is advised at $1,300. Customers believe they are saving $700 even if competing stores sell similar laptops for $1,000. Next, point number 9, the power of habits. Small decisions create big financial results. Financial success is rarely determined by one major decision. Instead of it develops through thousands of small habits repeated consistently over many years. Automatic savings, budgeting, investing monthly, avoiding unnecessary debt, reading financial books, and tracking expenses create powerful long-term results. Habits reduce the need for motivation because good behavior becomes automatic. The psychology of money teaches us that systems outperform willpower. Rather than relying on self control every day, successful people design routines that make smart financial decisions effortless. Example: Michael automatically invests part of every paycheck before spending anything else. Over 20 years, this simple habit builds a substantial investment portfolio without requiring daily financial discipline. Next point number 10, building a better money mindset. Master your psychology before your portfolio. The greatest investment is improving your financial thinking. Markets will always rise and fall. Economics will experience uncertainty. Opportunities and risks will continue to exist. The people who succeed financially are not necessarily the smartest. They are often the most disciplined. They understand their emotions, recognize psychological biases, question assumptions, think independently, delay gratification, and remain patient through uncertainty. Financial education is valuable, but emotional control transforms knowledge into results. When you master your psychology, every financial decision becomes stronger, more consistent, and more profitable over time. Wealth is not simply about earning more money, it is about making better decisions with the money you already have. Example for this point: two investors earn identical returns from the market. One constantly panics, changes strategies, and reacts emotionally. The other follows a long term plan with a discipline. Over decades, the disciplined investor builds significantly greater wealth because consistency beats emotion. Finally, the psychology of money teaches us that our biggest financial enemy is often not inflation, resistance, or market crashes. It is our own behavior. Every day, our minds are influenced by emotions, cognitive biases, and habits that quickly shape our financial future. The good news is that awareness creates change. Once you recognize these psychological traps, you can replace impulsive decisions with thoughtful ones, build healthier financial habits, and make choices that benefit your future self. Remember, wealth is built one small decision at a time. Master your mindset, and your money will eventually follow. If you found this video valuable, like, share, and subscribe for more practical finance and wealth building insights. Let us know in the comments which money bias has affected your financial decision the most. Thank you.